Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Good afternoon. Welcome to the BOGART Effect. I've got Patrick with me, and we're going to be talking about politics and wealth. Thanks for joining, Patrick.
Thank you for having me.
You know, we're in a time right now where, let's just say, political interests are dramatically divided, but at the same time, too, we're in a market environment where politics are a very big part of what's influencing it.
They're a huge part. And I think, for a lot of people, the distinguishing between politics and the market and their investments, that's become very blurred. Because as we've seen the rise of financial media, it's hard sometimes to separate financial media versus political media. And those two, as they're coming together from a consumer perspective, we need to be trying to separate and understand the role of each of those, the impacts of each of those for investors, and ultimately being, investing smartly.
Well, and emotions elicit response. Mm-hmm. And what we know without any level of doubt, that emotional involvement in an investment strategy is not a sound investment strategy. Mm-mm. So, as we dig into this, why don't we start with talking about, what are the roles? Obviously, we talk about Washington. Well, Washington's got different branches that all have an impact. Let's talk about each of them, and let's talk about the role that they play in the political process.
Perfect. And I think that's a great place to start, because right now, if you turn on any news outlet, this person said this person said this part of the government's doing this, and it's very hard to drink from a fire hose and be like, what does this actually mean? Who's doing what? So let's start with the president. Right now, it's President Trump. And really the role of the president in a lot of ways is influencing and biasing policy. When we think about laws and certain regulations, they got to go through Congress. But one of the things that has become more relevant of late has been executive actions. We've seen a lot of executive actions. We've seen policies like tariffs, for example. They don't have to go through Congress. They're going right from the Oval Office. And so the president biases policy a lot, but they don't set policy. So let's talk about the next piece of that is Congress and the Senate. They are what we would consider the check and balance to the Oval Office. And their role is really to develop regulation, develop policy, develop budgets, and then send it to the president. So when we have a Congress and a Senate that maybe has one political party and majorities in both, you're likely to see more movement in terms of what's able to be passed.
Well, and that's where we talk about the alignment, right?
The alignment, yep.
Washington presently sits where it's all Republican alignment. Mm-hmm. And when we talk a little bit about market preferences, it tends to be the markets want to see more checks and balances.
Yep.
Why is that?
So great question. One of the things think about it from a business perspective. If you're a CEO running a company and you think, well, regulations could change, that may make a little bit of a pause in your mindset as you go forward the next few years. How would regulations change? Well, they got to go through Congress. And candidly, we know when there's a divided Congress, let's say, for example, this is not the case now, but as an example, Republicans have the House, Democrats have the Senate. Yep. The likelihood we're going to get them to agree on a lot of different things to pass meaningful reform, very small. And so if you're a CEO in that time or a CFO thinking about capital expenditures, thinking about new kind of strategies for the coming years, if there's gridlock, the playing field that you're operating on probably going to be pretty close to the same as it was at the beginning of a presidential term. Yep. On the flip side of that, you look at there's alignment right now. Doesn't matter whether it's Republican or Democrat alignment. When I say alignment, just as a reminder, that's Republicans have the presidency, Congress, and Senate.
So it's all the same political
All
affiliation.
the same. Right now, the Republicans have it. There's a greater chance today of policy change than if there were gridlock.
Sure.
When you have a greater chance of change, we know markets don't always love change.
Well, that's exactly right. Think about it. Market's trying to predict the future.
Yep.
Right. So it's a stock's price is its future earnings discounted back to today. it's deciphering a lot of noise, right? And by the way, it's not just Washington. It could be geopolitical, it could be the Fed, it could be company specific, but it's processing a lot of noise. When we talk specifically about Washington, well, yeah, that's a pretty large variable, as every reason you just already identified. And so whenever we see an environment of full alignment, all Republican, all Democratic, what that tends to mean is we're going to see more broad-based change, which means more uncertainty, which means more volatility. You know, when we came into this year basically saying this is going to be the year of volatility. And by the way, volatility doesn't mean down; it means dramatic amplitude, right? And amplitude is actually normal in a market environment, right? We're coming off of 2024 and 2023 where there wasn't a lot of amplitude, right? Like 2024, we actually only had a roughly 8% drawdown at worst point, which I hate to say it, that's not normal. Most years actually have more than 10 when we look at historical averages. So it wasn't a lot of volatility, but at the same time too, we saw which means less amplitude. And so now coming into this environment where we've seen a roughly 7.5%, 8% fluctuation, like that seems scary. And a lot of it is related to the noise of what's happening in Washington right now. Now, one thing I wanted to add, what role does the Fed play in this whole process right now as we're talking about politics and Washington and markets?
So the Fed's separate. You know, when you think about Congress, you think about the Senate, you think about the Oval Office, the Fed is separate from them in a sense. They're independent from political parties. They're appointed, now the Fed chair is appointed by the president, but they act independent. And so when you look at Jerome Powell, you know, there's no Republican or Democrat logo next to his name. It's just Fed Chair Jerome Powell. And the Fed's main role in markets is to essentially set monetary policy. They set interest rates. They help how much money supply we have. And they're really a often overlooked piece of the investment world if you're looking at it from a political lens. And it's not that the Fed is not as important as Congress or Senate. You could maybe even make the argument they're more influential to markets, but they're a very important piece that often I'd say from political discussions don't get talked about in the investment world enough.
And I think what also gets underscored when we're talking about the Fed is it's not only their policy, it's their posturing and rhetoric. A lot of times we see a lot of volatility associated with just comments that either Jerome Powell, Fed chair, says, or even some of the Fed presidents can have an influence because they could be an indication of more of what the general consensus is of the Fed, right? And not that, again, that's bad necessarily, right? But we're getting a different variable, of course, that has political ties to it that ultimately does still have a very large impact on the market. Let's dive into what is the impact that the political parties have not only on the markets, but behaviors associated with that?
Great question. Political parties, we know, in almost every case, will bias someone's view on how they feel about the economy, how they feel about the markets, the job market. If you were to look at, you know, take last year, if you did a poll, and there have been a lot of surveys done across Wall Street to say, okay, you know, what's your political party? How do you feel? The political party not in power, those people surveyed, in almost every case said, hey, we don't feel quite as good. If you surveyed people that aligned with the political party that's in power, in the majority, they were like, hey, you know, it's not bad. The election happens, what do we see? Switched almost overnight in the charts. That's really surprising, but not surprising. It's surprising to see such a shift, but the economic data really didn't change.
At all, actually.
It didn't change at all. So the sentiment of the consumer is, in a lot of ways, we have to acknowledge, tied to their political biases. Some more than others, sure. But there is a little bit of that. And you know, it's hard to, you know, no one's at fault. Everybody feels that way because when you think about coming off a campaign season in particular, where maybe one campaign saying, well, this is how the economy is. Well, if that's your side, you're probably going to begin to really digest and grip onto those viewpoints.
Well, the incumbent party, no matter which affiliation, always says the economy is doing great.
Exactly.
And again, if you're on the other side of that from a perspective, you're not going to feel that way. And what I also find interesting is there's no direct correlation with the market and what the political party is that's in office. Or, and by the way, when I say office, I'm talking all of Washington, right? So this is the House, the Senate, White House. And so probably a good segue to talk about the market, not only in election years, but post-election years. I've had clients that have flat out said to me, with Trump winning, I don't want to even be invested in equities, that I want to go completely to cash. And on the other side of it, I've had clients that say, with Trump winning, I'm very optimistic about the markets and I want to put more in, right? So let's talk a little bit about that and really, what do we know about history and how the markets have performed, not only in an election year, but post-election year?
Great question. So in an election year, take last year, for example, we had no shortage of news topics last year. I mean, we covered all sorts of different, whether it be polling, economic data. We had different, President Biden stepping down from the campaign. I mean, we had everything last cycle. 2024 was an incredible year when you look at public equities. And so when you look at the political parties, we did a study and we really looked back and said, okay, if you just invested in one political party, when they were in majority, and then, on the flip side, if you just did another political party, Republican or Democrat, versus if you were invested across all political parties, pretty much
regardless of affiliation.
Through affiliation, the people who were trying to jump in and out of the market based on whether it was Republicans in charge or Democrats massively underperformed. To the point, I had to double check the data. I was like, this is a dramatic underperformance. And so to the degree that when we're thinking about political parties in power, Wall Street and the stock market and the bond market, they don't have political parties that they're beholden to. They're beholden to economic data, corporate earnings. And when you take a step back, remember, investing, particularly in public equities, is ownership in a company. To use an example, Domino's business model is really unchanged from before an election, presidential election, to the day after. It really isn't changed. You still, if you own Domino's stock or Papa John's stock or whoever, your business model, your valuation really hasn't changed despite there being a change in DC. And that's really important to understand is you're investing in businesses and those business models don't just change overnight.
Well, and I think it's also really important to emphasize timeline, right, with all of us, because anyone who's investing in a stock or the markets or an ETF that has equity-based exposure, the time horizon associated with that is not the next 3 months or 6 months or even 12 months. Anyone who's investing with the type of risk profile of a ownership in a stock or public equity investing should absolutely be using a longer time horizon. And this comes back to this whole conversation around political affiliation. And you're spot on. What we have shown time and time again is the investor that stays the course regardless of who's in office or what the political composition is of Washington has absolutely outperformed the investor that tries to time the market, right? And the thing is uncertainty is uncertainty. And we're in an environment right now where our uncertainty has uncertainty. And it's one where we're going to go through change. We know that we're going to go through change. We tend to still, because we have a longer term orientation or thought process, we tend to stay a little bit more opportunistic associated with this type of market environment. Coming into 2025, we knew that there were certain asset classes that were overvalued. We also knew that there were certain asset classes that had underperformed, right? And their valuations on a relative basis are more attractive. And I think about this market environment specifically where 2024, 2023, they had a very similar investment profile where you had the Magnificent Seven that contributed to a large percentage of the outcome, right? So 2024, Magnificent Seven was roughly 53% of the performance of the S&P, 64% of the performance in 2023. So because of that, that those are stocks that, yes, they have done well and they're large companies, they've had a large impact. There's no political bias associated with owning them. It's coming back to sentiment and what your perception of comfort is. You look at 2025, those same companies are getting punished thus far in the first part of the year here. Yes, I'm going to tell you right now, coming into 25, those valuations were probably ripe to see some type of correction or pullback. No one ever knows when it's going to happen, ever. But this comes back point blank to this whole conversation around timeline and affiliation with any political party makes absolutely no difference for long-term investment success. Right.
And when you think about where cash flows are coming from, and if you shorten the time horizon, your probability of loss increases. If you extend the time horizon, you dramatically increase your chance of success, regardless of political party. I mean, that's true with any investment
Bingo.
that you make. And one of the things I want to hit on to that point is, when we think about politics, when we think about investing, there's a big difference between policy proposals versus policies that actually get implemented and passed. And one of the things that we'll often have discussions about is, and let me back up, we in no way are saying politics and investments don't go hand in hand. We need to be paying attention to what is being discussed on a policy perspective. We need to be, proactively planning for some of those things. But from a policy perspective, there was lots of things on, just to use an example, this last campaign cycle that were talked about. We talked about different tax policies that may be planned. And if you were to go front run a trade in anticipation of those things, it could change in a millisecond. And all of a sudden, the trade isn't really as effective.
Well, and look at how the markets reacted to tariffs, right? And the posturing of tariffs. And this is truly changing hour by hour right now. I mean,
yes, it is.
It's not even a day by day. We had the first proposal on tariffs on Canada and Mexico, market's down 700 points. All of a sudden, they get paused for a month. Next thing you know, the market's up 300 points. Literally same day that happened, right? Like that's the way that news can move through and have a direct impact on, again, not policy, just discussion around policy. And I'm going to come back and say that's noise. Right.
It is noise.
And it comes back to, and I agree with you, we can't ignore these things because they can have systemic impact. I think of tax policy as an example. That can have a more meaningful systemic impact. But it's one where you can't necessarily build an investment strategy solely predicated on political affiliation.
I couldn't agree more. And I really think it's one of the things we talked about is, trying not to maybe front run or overly react to policy. And I find that when you take a policy like tariffs, for example, by 9 a.m. we may have one, statement from the White House. By 2 p.m. we may have a different statement, completely different scenario. And we're talking about a really short time period. And for a lot of people, that can be really stressful to have such big swings in a short term. And for investors, one of the natural reactions is to squeeze. Well, I need to just hang on tighter. I need to move. I need to be more active. A lot of times that doesn't actually help the investment landscape. Trying to maybe do micro trades or trade even more oftentimes actually is counterproductive.
Well, and I come back to kind of how we introduced this whole podcast is that's emotion, right? That's that is an emotional response to the environment that you're in. And again, when it comes to long-term success with investing, emotion doesn't sit well, right? It really doesn't at all. So we've talked a lot about just personal viewpoints and political biasings. I want to spend at least a few minutes here talking a little bit about investing tips and specifically what are guidance points that we should have for our audience on how to handle a political environment, specifically getting into some nuances associated with investing. To these types of let's just say elevated tension,
absolutely,
elevated emotional period of time.
So one of the first things that I would recommend to everybody is you have to have a financial plan. Everybody needs a financial plan. And when you have periods like this is the perfect time to do a financial plan update, to rerun the numbers, to say, okay, has anything in my plan materially changed? Balances may be a little different. The ending values may be a little, but has the plan changed? Has my financial health changed? And I think that's a really good starting point before even looking at the portfolio to decide, should I trade out of this or trade into this? Does the financial plan still work? I would venture to say good financial plan has prepared for this and planned for this exact moment. So doing a refresh of just a overall reset, am I good on the plan? Number two, as it relates to that, maybe in the plan, we need to adjust timelines for cash flows. Maybe we're bringing some expenses forward. Now's the perfect time to look at, we talked about it earlier, what is your risk timeline? What is your risk capacity? If we're looking now at expenses within 24 months, we need to be having different conversations about where those funds are coming from and really proactively maybe making some adjustments now, or at least talking and understanding the risks of staying invested for such a short time.
And I like to have visibility, right? Because some of that upcoming cash need might come from an income source.
Yep.
Some of it might be dividend income that's coming in off the portfolio, but some of it flat out needs to be liquidity and available access. I personally think, regardless of political environment, it's important to have a dedicated bucket or resource available for whatever your respective needs are. You know, we have a client, both of us have a client right now that's about to buy a house, right? Well, that's a great example where the more and more we can get in front of that prior to the timeline. Now, candidly, sometimes we're going to buy the house in a year. Sometimes we're going to buy the house. Oh, we're buying the house, right? Like that, that happens. The more we can anticipate the need, the more we can plan for it and the more we can de-risk a portfolio. Because truthfully, like as we're talking about sourcing capital for this particular one right now, it's like market's down. These asset classes are down. We don't necessarily want to sell here. Maybe it makes sense from an opportunistic perspective. Oh, but this position's up nicely. Let's go ahead and materialize it from there, right? That's why I think it's really, really important to have what we call the bucket approach, but it's a short-term bucket, an intermediate-term bucket, and a long-term bucket for these types of periods of time. And this isn't necessarily a political statement, because the reality of it is volatility happens for lots and lots of different reasons. Right now, we're just in a period of time where there's a lot of let's just say, political angst, which is amplifying volatility.
And to that degree, one of the things, we recommend to everybody, diversification. You have to be diversified. And when most people talk about diversification, they're talking about it from the lens of their investments. U.S. versus international, stocks versus bonds. You hit on something right there.
Hey, timer, real quick. Define what is diversification?
Good question. So diversification at a very high level is you're owning various different assets that will move in different directions in different market environments. This hasn't been the case of recently, but for a long time, there was a negative correlation between stocks and bonds.
Correct.
Bond prices were going down. Stock prices were typically rising. And on the flip side, stocks, and bonds were diversification components for each. That's how we really got to the 60-40.
Well, and when you talk about the 60-40, right? So that's 60% stocks, 40% fixed income. What we know, and this is modern portfolio theory, but when you have a portfolio that is all stocks, you have more volatility, more amplitude, higher rate of return. Whereas if you have a portfolio that's all bonds, lower volatility, but lower returns. But the whole concept behind modern portfolio theory is that a combination of the two together, you will actually get a more consistent, better return with less volatility than each of them respectively. Right? That's the whole concept behind diversification and maintaining that type of portfolio structure. Sorry, I interrupted you, but I thought it was important.
And very important. And it kind of goes into this next point here. We talked about diversification within an asset bucket, but you talked about the different buckets. You have to have diversification from your investments, whether it be Roth, traditional, pre-tax, or taxable, and really thinking about, okay, is there sources of different tax diversifications, but then is there different sources for where I'm pulling money from? Is that in a very secure, call it safer investment bucket? And that's important because that diversification of risk and cash flow can be separate from maybe your growth engines, because we know for retirees, you can't just have everything in cash because inflation's going to eat away at your portfolio. But you also probably, in some cases, can't have everything 100% invested in, call it like the NASDAQ, because it's going to be too volatile.
Way too volatile.
And
that's where, coming back to your statement about risk profile needs to align with investment strategy, which needs to be diversified. By the way, this isn't just retirees, right? Like I think of myself, right? Like I've got kids in school, right? I've got kids, or wife wants a new car, like whatever it is, right? There's going to be points in time that there's more short-term cash flow needs that I won't necessarily want to be dependent upon the market for. So, and this is where this conversation around diversification is applicable to all of us, regardless of market environment where we're at. We need to have the emergency fund / cash flow available to us when we're going to need that money, if it's within, let's just say 6 to 12 month period of time. Talking a little bit about history, right? I know we've alluded to, we talked about the historical study that we did, but we know that investing over a longer time period of time amplifies return. But bringing it back to kind of the thesis of what we're talking about today with politics, talk to me a little bit more about investing strategies in a politically amplified environment.
So, it really depends, in terms of what investment you're going into. It depends on the financial plan. One of the things that is incredibly important in this period is understanding for your cash flow sources. We have now opportunities to get higher yields on less risky investments because interest rates have gone up. And interest rates on things like money market funds are more elevated. And so compare that to, pre-2020 or 2022 when interest rates went up, there was really nowhere to get yield on cash.
Absolutely.
And now you do. So, I think for a lot of folks, having maybe a more conservative, what we would call bucket number one, more cash flow heavy bucket where things are going to come from is important. But number two is to not be on the equity side, jumping in and out of different sectors to try and front run and have a globally diversified portfolio because, well, yes, certain parts of the market may be affected at certain times, but to predict that on a micro scale is very challenging. And so that's where we come from the global
I like to use the analogy of building a portfolio is like baking a cake, right? Like you need to have certain key ingredients in order to have the desired outcome. Mm-hmm. Just like simultaneously, you need to have a certain amount of time, right? Like you can't put a cake in the oven for 2 minutes and expect it to be cooked, right? Like there's an amount of time that needs to be assigned to each of these different elements in order to get the desired result, right? I think we talked a lot today. Let's talk a little bit about social media and the media itself, how that impacts this type of environment. Because this is new, right? Relative to previous economic cycles, we now have access to information that we never had access to before. Mm-hmm.
And the market's able to process information way faster. Yep. Social media has changed. It's changed everything. I don't need to tell anyone that. What has really become relevant the last few decades is the media now and the news outlets, they need engagement. That they get paid through engagement. They need viewership. What is one of the easiest ways to enhance viewership? Well, is to broadcast to fear.
Yeah.
And when you broadcast fear, it makes people want to take action. And we talked about earlier, if you squeeze your investments tighter, if you take more action, sometimes that's counterproductive. More times than not, it's counterproductive.
I go back to my comment. This is emotion, right?
Yes.
Yeah, and I love that you're emphasizing that, right? Because and by the way, it's not just social media. I'd say it's the news. It's all media outlets. They propagate fear, right? And I'm not going to say that there's not teeth here to what's happening with the current administration, but the fact of the matter is economic data is still pretty good in this present environment. And we were just talking about earlier today when I was doing the client call, but ultimately, we're in an environment where we now have 97% of companies have reported fourth quarter earnings. 83% of them are favorable. Now, yes, we're seeing some guidance revised down simply because of uncertainty associated with new policy, right? But this is where I come back to my comment of our current uncertainty has uncertainty, right? And it's going to continue to be that way probably for the next 6 months, if I had to be a betting man. The current administration knows that they have a finite period of time to create impact and do these things to hopefully demonstrate that what they were doing is the right strategy going forward. And of course, we know that we're coming up on the midterms. Sorry, not coming up yet, but we will be coming up on the midterms. They need to have time in order for these things to have impact in order to be able to demonstrate that it was the right decision, right? And because of that, we're going to have some volatility. But frankly, I still, because of the longer time focus for what we're talking about, I think of it opportunistically more than anything else, right? And do not let emotions be the driving force for your investment strategy.
And one of the things I think a advisor really brings to the table is in periods like this, helping folks understand, okay, you've just probably seen all sorts of different things on social media, different claims, different opinions. What actually matters to me? What moves the needle on my financial plan? And you need your advisor to step back and say, hey, I'm objective here. This is what I think maybe we need to be, not only identifying risks, maybe we need to take action, maybe we don't. But to have someone in your corner that you can go to and trust and say, hey, I'm seeing all these things. James, do I need to do anything? Can you do a double check? And have someone quarterback that for you is one of the biggest reasons I think people should have an advisor.
Without a doubt. Well, and I think an advisor specifically that can talk about different strategies and different market cycles, that they're able to navigate risk associated with your specific needs. At the end of the day, a financial advisor's job is to solve your problems. And I think a really good one will put themselves in a position to be able to anticipate what your problems are going to be prior to them actually happening. This is one of the many types of environments that I think an advisor can actually add value. But I think it needs to be rooted in planning and staying fundamentally sound to your overall needs. Patrick, this was a great conversation. Thank you so much for the time today.
Thank you for having me.
Take care. The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.